about today? Well, today we're going to talk about, well, since I got a mortgage guy here, we're talking about what's going on in the mortgage industry, what's happening with interest rates. We're going to talk about we've got an election coming up. Every mortgage lender we've had on here prior to this has threatened us that we're going to see a mortgage rate drop prior to the election. We'll find out if that's true or what we really know. And then we have an NAR settlement that has just recently occurred that is changing the way we fundamentally do real estate, which really affects largely first-time home buyers, VA buyers. And how is that NAR settlement, National Association of Realtors settlement, how is that affecting the mortgage industry, or does it have any effect at all? So that's why we brought him back. So Chris, let's jump right in. Mortgage rates right now, we're middle end of August, I guess we can say safely. Where are we at with mortgage rates? What are we seeing right now?
Good question. It's been a big week for that. There's a lot of financial news coming out this week that kind of hinges on that a little bit. So the Fed will be speaking tomorrow morning, and it's thought or expected that the federal funds rate, the interbank offering rate that the Fed sets, likely will be under pressure and potentially lowered a little bit. That should have a knock-on effect on mortgage rates and all other interest rates to consumers. So we've seen the rates as high as the mid eights. Over the last couple months, they'd been down into the sevens. And over the last couple weeks, we've started to see a little bit of a reprieve down into the sixes. Earlier this week, the bond market yesterday even threatened some really nice interest rates, mid sixes potentially. So usually there's a couple day lag when you see that in the financial markets and the bond markets for mortgages. It usually takes a couple days for that rate to hit the consumer. But it looks as though this week things are setting up to potentially continue that direction.
So we have been saying to people that when elections the years come around, we generally see a rate drop. Are you suggesting that this is going to be a typical election year where we can maybe see that? Probably.
Wow, baiting me in on that one. Well, it's hard to traverse, honestly answering that question without being political. To your point, election year,
right?
Usually somebody is trying to shine it on, right? Showing that things are good or make things good. Sometimes at the last minute, sometimes not. This situation is a little bit unique to me with the changing candidates that late in the game. I think that is going to have a pretty profound knock-on effect, and almost potentially from the outside anyway. And this isn't a Townebank reference or anything. This is my own personal view, is that they might be changing course on what they were trying to do, whether they were trying to keep it not so great leading up to the election, so people looking for help, or now are they trying to change around and be like, no, everything's great. We've got it. It's okay. But I think regardless of what message comes out tomorrow, what they do, skeptical eyes are going to look at it from both sides. Is it, Jerome Powell and the Fed tended historically to lean a little bit to the middle to the right. The way they had been functioning over the last couple of years didn't really mirror that. So right now is a really interesting time with what's going on to see if the message is really for the right reasons, or is it going to be a political message tomorrow? And I don't think anybody's really going to be able to put their finger on it and prove it one way or the other.
Well, it does seem, and I wrote in the write-up here, it seems that the interest rate just magically, the housing interest rate magically just drops. Like it just does. I mean, it's like magic, right? It's like we're going, oh man, of course we're not going to see what we saw. I mean, we're not going to see 3% or 2.75. I'm sorry. That's just a fact. We're not going to get there. But I'm like going, okay, but magically every election year, we used to see this rate drop, and it's generally pretty significant. It's not like a quarter of a point, it's generally pretty significant drop. And it's like going, okay, well, if you can magically make that happen, right? Like right before election time, what potions did we need in order to make that happen earlier? Because not that much is changing between August and November. All right. I mean, let's look what we got: September, October, and then November 4th. So basically we got 2 months, 2.5 months, right? What in 2.5 months? And I'm not trying to be political here. That's not my goal. It's just that it is ironic. Is it ironic or coincidence? I think it's irony. I think it's irony that we say that the interest rates should drop before the election, and nearly every election they do.
So my own view, and I'm not an expert, an economist or anything like that. I do have a degree in finance, but when I look at it, the mortgages are eventually turned into RMBS, residential mortgage-backed securities, in the United States.
Right.
That's a pretty safe, conservative type of investment. In fact, there's only so many things that are safer than that, such as a treasury and some other stuff. So where people can park their money at what return is what's going to draw people into the mortgages, into those bonds, and whether they like the coupon or the functional finances of how that's paying out, makes it more or less attractive. So if you alter what's available in treasuries and what they're paying and stuff, you can kind of get people interested in these other bonds a little bit easier maybe than you would think on the front end by, just having certain markets have certain availability, treasury auctions and stuff. The timing of all that stuff is not a coincidence.
Yeah, well, that's the way it certainly feels, right? It's not a coincidence. All right. So in the meantime, we do have these interest rates that I think we're kind of getting used to over time. I think people are slowly getting. You're disagreeing with me on that. I feel like we're starting to
begrudgingly. People are dealing with them begrudgingly.
Okay. I think that's fair. I say getting used to because I feel like, they are what they are. I can't change it. You're right. It's probably more begrudgingly. I don't want to sit on the sidelines anymore. There's more houses coming on the market, right? We're seeing an increase in inventory,
a little bit. Yeah.
And so go ahead.
I'm seeing a huge amount of pent-up demand. So now that we're in August, we're almost 2 years since the rates really started to go up.
Right.
And there's a huge amount of pent-up demand. The move-up buyer, the person that bought the $350,000, $450,000, $550,000, $650,000 home, who now has another kid or wants another room and a nicer backsplash, they're not at a 3 interest rate on currently what they have.
Right.
They're not selling that house, moving to a 6 or a 7 interest rate and spending another couple $100,000. That's going to be a significant increase in their monthly payment, like maybe well over $1,000 for a nominal difference in accommodations. So the move-up buyer who is selling their house and moving up, they're almost frozen right now. And most of what we see happening right now are the transactions that have to happen. People that just got married, people that are moving, people just got their first job, first-time home buyers, divorces, a lot of stuff like that are the transactions that are happening now.
Okay, well, that's interesting because I think there's another transaction because this just happened with a really good friend of mine, right? Has a house, purchased it 8 years ago, $500,000, right? This and whatever he refinanced it down. I think he has 2.75 interest on it.
Sounds realistic.
Okay, found a house over $1 million. Decided that what he was going to do, a HELOC on his residence, right? Not lose to 2.75% interest.
Yeah.
To purchase into the house because he had all this equity. I'm like going, well, that's pretty genius because where are you going to get that kind of cheap money to do that? And so are we seeing more of that?
Yeah, a lot of people have a good amount of equity, but it's in that situation. I still need to ask the question, well, what's the exit plan? Was there an exit plan? Because you're still booking a lot of money on that HELOC at right now at 8.2. So yeah, the 2 is great. But now if you have another 400,000 at 8, isn't that really like 5.5 weighted
yeah,
average.
but if you're thinking that you're thinking that interest rates are going to go down, you're going to buy it, and then you're going to refinance it, right?
So the in my footprint, I'm not super rate sensitive here in the Greater Triangle.
Mm-hmm.
And the reason I don't think people are as rate sensitive is the appreciation is almost a problem in our footprint, where the rates for 2 years now have been in nearly the 25-year highs, but homes have also appreciated
Right.
10 to 20% from the 250 to
Absolutely.
600,000
you're right.
price point. So the difference in mortgage payment at the higher interest rate might be $400 a month. That might be another $4,800 you spent in the next 12 months on the mortgage payment. That's a lot of money.
Sure.
That's why people are waiting. But then they realize, wait a minute, that $500,000 house that I was looking at is now $550,000
right,
or $570,000.
Right.
Who's stepping over $70,000 in savings to save $4,800?
Right.
So it doesn't make good financial sense to wait in our market.
Right.
Other markets, and I'm not bashing other markets, but many markets are not nearly as robust as where we are here in the Greater Triangle.
Right. That's the point. I think that's the point. I think there's other markets that are not nearly the strong. And I want to say we're strong.
Absolutely. So we have a lack of housing, and we still have seen appreciation through this period of time. So I think you were going with this, leveraging that low rate you had on the old house. You can do that, and you can borrow money a little bit cheaper, but I caution in that scenario, though most people feel the rates are heading down. If someone gets it wrong, you now have a large piece of money at a variable rate, and it's no longer your primary residence.
Sure.
So it adds a little bit of risk to it. I'm more of the fan of just get into the new house at a crummy current rate. And as they get a little bit better, you refinance it down. And then it might be 2, 3, 4 times you need to do that. But hopefully you can get from where they are now down into, mid 4s. Something like that. That would be ideal.
Yeah. I just think it's interesting there are some options available that people have the choices to do.
So the bridge loan or the HELOC to take money out of your other house to roll into your new house is super common right now.
Right. Yeah. That is kind of
absolutely.
So let's talk about what Townebank Mortgage, do you guys have any new products coming out right now?
So when the market slows down, the industry loves to go in the closet and see what people haven't been playing with for a while. So are there really any new products? Not really. Have they taken a couple old products and renamed them and shined them up? Yeah, absolutely. Big buzz going around the last couple months is DSCR or debt service, type loans, where you're basically using the cash flows, and they're all advertising like it's, they just invented sliced bread and it's new and this and that. Banks have had that forever. It's just a commercial loan is what it is. And you're using the cash flows to show you can service the debt. And, bank statement loans where you're using bank statements to qualify as opposed to using like W-2 or your actual, tax income. They're a little bit more popular now. So I wouldn't say anything new, if you will. If we go back to the mortgage crisis, they opened up so many new fun products at that point. I don't think people are ready to quite play in that space, meaning like option arms and negative amortization or anything with unfavorable terms. So we do have a lot of good products out there right now. As a bank, what you'll find when you partner with a bank, you'll get other options. So as a depository member, banks can make certain other accommodations for those account holders that sometimes are more favorable than going to just an internet lender or someone who doesn't have a depository relationship with you.
So what are some of those advantages? I think people would love to know what advantages, because I think, the online lender is very popular simply because, they put, millions upon millions of dollars in advertising. And we all know that, you see something enough, you'll develop a preference for it. It's called the mere exposure perfect in psychology. But what does a bank, Tell us the advantage of doing the bank. Give us some advantages there.
Yeah, examples of that are physician partner loans or construction to perm loans for self-employed individuals who, may have only been self-employed 3 years and not 5 years or not 10 years. Unique loans like that, you can take the whole relationship into account as opposed to just, 2 or 3 pieces of the loan. So if you have a depository relationship with the business side and you also have a depository relationship with the borrower, you can weigh other things into it to offset those risks. And sometimes that'll allow you to proceed with an easier underwrite as opposed to the standard Fannie Mae and Freddie Mac guidelines, who are great for most individuals, but unique employed individuals or newly self-employed or people that aren't just vanilla W-2 borrowers, some of those other options are more favorable. And what I mean by that is being able to provide all the documentation for approval sometimes will be easier in that fashion, yet they're willing to give up a little concession in rate or some other area to make the acquisition of the property work. An example of that, going back to what we were talking about before, a lot of times getting in the property, especially in a footprint like ours that has great appreciation, is honestly more important than the rate you got into it at.
Right.
You look at that 5, 10, 15, 20% appreciation over a year or two. If that continues, with the average price point of the home in this footprint, I don't think people are necessarily worried about the interest rate. They don't like it. They're not wanting to sign up for that higher payment, but they know as long as they can cash flow and make that payment, that investment in that house is likely to do more than just provide a domicile for your family. It's likely to really influence your retirement at a later time. And I think that's how a lot of people look at stuff in our footprint.
Well, I think it's interesting because, when we talk about, mortgages and lending and we do that, I think it's important for people to understand that there's a difference. Not all lending institutions, whether it's mortgage lenders or banks, are created equal. They have differences, and I think it's important for people to go. I think I would want, if you're out shopping mortgages, check out your town bank.
Absolutely. So many people zoom in on the mortgage, meaning the mortgage they're getting on the house, and they like, I've got to do a great job. I got to make it as cheap as possible. And they zoom in so much on the mortgage they're getting, they forget that the mortgage is just a piece of their overall financial plan.
Right.
So your goal isn't to minimize the cost of the home. Most people, when I speak to them, their actual goal on why they're buying the house and what they're trying to do is to amass wealth for retirement years. So when they're buying the house, their financial plan at that point is to gain equity and put wealth away for retirement years, put equity away for retirement years. So I can show you very easily where you can zoom in on the mortgage and you can use all your money that you saved and everything to make the mortgage a small piece and have the least cost to you. So by doing it that way, you might save another like $1,200 a year. And you're right. That is saving maybe $1,200 over a situation right next to it, similar. But I argue, zoom out a little bit. Now look at your overall financial platform and what you're trying to build as a family. And I guarantee you, if you allocate money to your financial advisor and other pieces, you absolutely can have a lot more zeros in your retirement portfolio if you do it a little bit better in terms of looking at the house as a piece of your financial platform instead of the whole point of your transaction. And I can show you lots of situations where the cash flows might be slightly different. The cash to close might be slightly different, but that by going about it that way, you're going to have less risk. You're going to have less exposure to payment increases or changes, you're just going to have a lot of situations where you're less likely to be under pressure even long term, and you should have a lot more zeros in your retirement account if you do it that way, as opposed to putting all your money just trying to reduce the cost of the mortgage itself.
That's well said. Really well said. All right, we got a few minutes left here. Want to talk about, you're aware of it. The world's been aware of it. National Association of Realtors has done this $485 million settlement. There appears to be more, by the way, more suing going to happen. It's changed a lot on the realtor side in terms of now we have, for us in North Carolina, not much has changed. We've always had a buyer's agency agreement. We've added a few things to it, but most of the country has not. And so now the buyer signs an agreement that says basically that they're willing to pay a certain amount of the commission for an agent. And this is met, we're still at the early stages. It started on the 17th. And one of the biggest things that has been a concern from the very beginning is first-time home buyers and VA loans, because basically there's not been an avenue for how those type of buyers can pay for a commission on that side. And so this is what the question is then is, how is this, or has it affected you in the lending industry? How have you seen this play out so far? Not that it won't change.
Yeah, that's a great question. And it's obviously super hot button in the industry. We just got some recent guidance on it, at Townebank. We don't really have skin in the game on that, any influence one way or the other.
Right.
But, years ago, the mortgage industry went through a comp overhaul, and it's really alarming when things change like that. So the way we see it, and what I'm seeing, and the way Townebank looks at it in North Carolina, my experience so far, particularly with good real estate agents, is it's business as usual. I'd always, when I have a new customer come in and get pre-approved to do a loan, as a loan officer, it's super important. One of the most important things is to make sure your customer, upon trying to buy a house, is comfortable coming up with the cash to close and has enough cash to close. Even if obstacles come up in the way, such as an appraisal shortfall or needing some other inspections or other items. So as a loan officer, it's super important to have those conversations about where the money's coming from and is there enough money to get into the house. So as a loan officer, you're already having those conversations, and loan files such as VA or first-time home buyers, where there's limited down payment money and such like that, those situations have always been handled this way and likely to continue to be handled this way. You just have to send that buyer with a good realtor that's finding them situations where they can succeed on the house purchase. An example that would be making sure that they're looking at houses that the seller is willing to pay comp on.
Okay, but there's a problem with that, because we've already been told by attorneys that if we do that, we're looking at a suit.
Why would you do that? You don't have any reason to do that. If your customer comes to you and tells you what they're looking for,
I agree.
Then it's your job to do that. So if a borrower doesn't have the money to pay that,
right,
it's their job to say, hey, we're definitely better off looking at houses in this fashion. So I'm not saying how it's going to play out at all, but it's always played out this way. If a borrower doesn't have the money to proceed on a certain home, they don't proceed on it, and they find one that does work for them.
Now we're talking, it's about commission. So now we've got issues. So if you can't afford the house, you don't look at the house, right? If you've been approved for $300,000, you don't look at a $500,000 house.
That's exactly
we get it, right? Difference is here, the expectation is, we've been warned by some attorneys that have said, if we find that you're steering because you will not take a buyer to a house that's not offering commission, we're looking for you.
So remember, it's early. It's just early in it, and everybody loves to jump to the the worst scenario in there. I'm quite sure it's going to work itself out.
I do too. I do too. I just think I was just curious because that is a thing that we have to be concerned about that, right? Because we thought, well, okay, as real estate professionals, we thought, okay, we're going to do the settlement, we're going to be done with it, it's going to be over. We've kind of all come to an agreement, but now we're getting, okay, if you don't show, they're one. So that's why we're wondering: is the mortgage industry willing? Is there any willingness on their part to say, hey, listen, we'll help the buyer out as part of the mortgage to cover that part of the commission if they're paying a commission?
So what we've seen so far as a company, I haven't had any situations with any of the buyers that have come through me where any of this was a surprise or even a concern.
Right.
We have had certain situations pop up with realtors who maybe aren't full-time realtors, maybe aren't the strongest professionals out there, didn't have those conversations early.
Got it.
Showed houses that the borrowers didn't have the money to really make happen. And then it kind of popped up late in the game. And then it wasn't a very good situation. So the only situations we've seen where it's actually problematic is where there's not a good communication relationship with the realtor and the buyer to begin with. So
this really comes down to what you and I are talking about here. And by the way, we're not adversarial on this at all. I want people to understand we're not being adversarial, but we are dealing with a lot of new things, and we're there's a lot of stuff happening here. I think what we're saying here is, and it's really important that whoever your mortgage lender is, that this is communicated extraordinarily clearly. Of what you have to expect, but you can't, because you're really the first stop before the real estate professional.
Absolutely.
I mean, and this is where I think it gets interesting. The mortgage lender has to be clear on what they can, because when they sign this buyer's agreement with the real estate agent, right, and they agree that they're going to pay some sort of percentage of, right. Can they cover that?
Yeah, that's a legitimate concern that absolutely needs to be gone through with the loan officer. And once you get to the other side of that, everybody jumps to, coming back to, are we steering this out or the other? The buyer is telling you what they're interested in and what works for them. And you got to listen to that.
It's just, I think we're in such early stages. I don't think we really know what's going to happen at this point. I think we've got some work to do. I got a feeling things are going to change as this plays out. I got a feeling things are going to change. I think it's going to be pretty fluid.
I feel the same way. At the end of the day, the whole point of how the system used to be set up was there was a marketplace. You could bring buyers, and there was certain expectations, and that happened for so long. I believe it's kind of viewed as a precedent has been set. And I think that's something that, much, more powerful people than me are really kind of thinking through and trying to figure out how that plays out. And I think at the end of the day, the point of the lawsuit was to protect the buyer.
Yeah, I agree.
Not to harm the buyer.
Yeah.
And the point of it isn't to make it harder for first-time home buyers. The point is to make it,
well, it shouldn't be. But again, we're experiencing some issues, right?
That's right, little growing pains with sounding great in a conference room.
It sounds great. It sounds great when you talk about it, but then when it actually comes to the rubber meeting the road, it doesn't. So we've done way over time, but this has been a lot of fun. This has been great. You've been amazing as always. You always come bringing everything. Tell people how they get a hold of you, Chris.
Christopher Coy with Townebank. It's pretty easy to reach me. Phone is always the best, 919-306-8895. Or you can send me an email at ccoy@townbank.com, TOWNEBANK for Townebank. And look forward to helping you.
Awesome. Chris, thank you, folks. It's the show I say to you every week. You had a lot of choices, chose us. Thank you. Thumbs up on YouTube, please. 5-star positive review wherever you listen to the show. Thanks for watching us on DBTV. I say it to you every time. You know what that is. Ciao, everybody.